Thank you, Zainab. So you are all welcome to the second session of today's class. Without further waste of time, our lecturer is going to begin principles of account again. From where he stopped, he's going to continue from there. So please do well to call other of your friends to join in. Mr. Samuel, you can take it up from here. Thank you.
Yes, thank you so much, moderator. Thank you. So we welcome you back once again. Welcome everyone of you back once again. So let's proceed from where we stopped. So if you have questions, yeah, so please, if you have questions thereabouts, thank you, feel free. When is the time you can indicate?
Mr. Samuel, we are finding it difficult hearing you, please. Maybe you should increase the volume on your device.
Okay. Hello, can you hear me? Am I audible? No?
Yes, it's clear, but really not, it's not really audible.
Oh, can someone also please confirm?
I don't know if you can hear him on the indicate on the chat room. If you can hear him, please indicate on the chat room.
If you can hear me, please indicate. Just indicate on it.
Okay. Michael Faith says he's hearing you. Okay, you can go on, sir.
Okay, thank you. So, if you have questions, as I've said, please feel free to ask. When is the time, the appropriate time? I will let you know. I can hear you. Yes, thank you, Dr. Lauluwa. Yes, okay. So feel free to ask so we can solve it. And I also have questions also for, more or less like a classwork that we will do to just. So if there are some places okay, my audio, I've even turned it to the highest. I've turned it to the highest. So I will know what could be. Or you can increase the audio of your device also, because I've increased the highest from here. I don't know what could be going on. So without wasting much of our time, because of the limited time we have. So let me share my screen to start from where we stop. So, yes, depreciation is what we'll be looking at today, right now. Depreciation, we are all familiar with depreciation. We all know what depreciation means. We all have idea. We all buy devices, we buy phone, we have cars, and we see that it deteriorates. We see that it is not the same way we bought it. After some time of usage, we see that it deteriorates. We see that it starts losing its potent or its function, this and that. So, but depreciation also happens in accounting too. So it plays a major role in the financial statement, especially when it comes to tax, thereabouts, and everything. So we're looking at depreciation, and these affect the fixed assets that you have. So depreciation, that's the fall in value. Is defined as the fall or decrease in the economic value of an asset. So due to wear and tear, due to usage, due to obsolescence, due to passage of time. So these are reasons. So accounting for depreciation is the systematic procedure of allocating cost. You allocate cost of a fixed asset over its estimated useful life. So because of the assets you have as a company, which, I have said that these assets, these capital items that you bought just to make sure you earn more. They are losing money, they are making more money for you. These are things we use to make more money. It's always depreciated. Now, company needs to be lean, because if there is no asset, how will you able to generate money? How will income come in? Now, neighbor person, if the car is not taking care of it, and if that car just wreck and use the car wretchedly, carelessly, when will he get other income? So there's always a portion of it allocated, earmarked somewhere that in case you can able to get another one. So there's a portion of money that you just allocate for it. Okay, this is the depreciation for the year. But as you proceed further, you understand better. So it's charged to the final account. It's an expense. It's always charged as an expense. It's always charged to the final account. So every year you allocate, there's a percentage. It depends on the percentage you decide to choose. So every year from the from the financial statement, from the day-to-day running of the business, from the money that comes in, you have to mark a certain percentage, a certain amount of money somewhere for these assets, so that it will be easy for you to get if you want using or you want to replace the thereabout. So assets associated with depreciation, the assets that are associated with depreciation, we have fixed assets. Those fixed assets, we have the plant and machinery. We all know generators and about plant and machinery, the machines we use, the factory, those ones, the motor vehicles we use, furniture and fitting, buildings, premises, etc. These are assets that are associated with the position. So I would like to ask, there is no land here. Why is there no land in this place? Because it is also an asset. Because I would like to know, why is there no land in this list? We have plant and machinery, which is a fixed asset. There's a motor vehicle, which is a fixed asset. There's furniture, building, etc. But there is no land here. Why? Please get on the chat. Tell me, is it that I mistakenly omitted land? Is it an error of omission? Please let me know. If that was an error of omission, let me know that I didn't put land, or it was intention and you know the reason why I didn't put land there. Okay, 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 yes, Thelma, good. Land appreciate. So there's no way you can put land. There's no way you see land depreciating. Please just tell me a place where the land is depreciating now. Let me know. Then one, I will quickly rush and go and buy. Land always appreciate. The land you see that it's just a little amount today. In years to come, it appreciates. Land appreciates. So that is why land is not here. For all other ones, the metal vehicles, the furniture and everything, they depreciate. They do depreciate. So that is why we, we have to allocate an amount. And depends on the percentage of amount you are marking for such depreciation. So causes of depreciation, as we just read also, we have course reason why we depreciate. We have physical factors. So as a depreciating value as a result of physical factors, which is flood, most of the time the rainy season, or when you go to the island in that rainy season, you know, if they don't go here during that time when it is raining, it will get into your car and destroy a lot of things and everything. And so even in during the sunny area too, the heat also can also affect the chairs of your vehicle and everything. So physical factor affects it, which might cause your vehicle to start get rust. You see that same rust or thereabout, maybe at the bumper or at the down part of the car. So physical factor, but it's wear and tear. So the more you use your vehicle, the more wear and tear is come. The wear and tear, you have to see it on it. Most especially when you now discover that the rules we have, they are not good enough. The rules we have are not good enough. You see that before you know it, you can't even last day. It's kind of, how come? What happened? And everything. So passage of time too also affect it. The number of years you use the number of years you use your assets, you will affect It also affect the wear and tear of it. It also affect the depreciation of it, and also obsolescence. That means it will, before you know it, due to technology, what you just get will just be out of date, no more useful again. And that happens most of the time on phone, especially the iPhone. You get iPhone this year, iPhone 6. Before you know, next year, you bought it at this so huge amount. By next year, another one comes out. Before you know, the one you bought previously, you just see this. The money just go down. The price of it will just go, no buy, just go down. And the new one increase again. And the following year again, another one will come out. The one you bought at this same huge amount, when you go to market again, the amount has gone really low. Has gone really low. Sometimes that's technology. Even sometimes government policy too. They might make a policy that will affect that will affect the the, the asset also. It will affect the asset also. So these are the causes of the decision whereby we have to just ensure that we mark an amount for all these things in order to replace it. So factor to be considered in computation of the position. What are the factors to be considered? So we have to look at the method of the position you want to use. We go to the method of the position. Depending on the method of the position you want to apply, the historical cost, that's the cost of of that asset. What is the cost? The historical cost of that asset. The estimated useful life. So how long do you want to use it? You get a phone and you're thinking, I'm gonna use this iPhone 15. I'm only going to use it for 2 years. After 2 years, I'll get another one. After 2 years, I'm getting another one. So you you have to you have to now start your marking an amount down. Okay, it's 2 years, then I need to be saving this amount monthly or quarterly or biannually in order to be able to get another one. So it depends on the use number of useful life you want to do such things. Is it vehicles, is it machinery? Like I should buy a car, I should use it for 5 years. After 5 years, I should change it another for me to know that yes, I'm alright. So there's no use more than 5 years. These are the factors you have to consider. How many years you want to use it before you get to the replacement. An estimated scrap value. So okay. So estimated scrap value. That means at the end of it all, at the end of the estimated life, how much am I going to sell it? Does he have a second-hand value? These are some things when you use it, it doesn't have a second-hand value. It's as good as you just go and trash it. No one's going to buy it from you. No one's going to buy it from you. There are some cars that have second-hand value, even if you use it there. So this is somebody that will still come ahead and still buy it. You still come and say because it has value. So how much are you selling it? How much is the scrap? We estimated that okay, if I use this car for 5 years, at the end of 5 years, the amount I should be able to sell it. That's the estimated scrap value. So the internal cost of the depreciation, the external cost of the depreciation, which we have to look at the external costs, which the technology, the policies, the economy, or thereabout, which are talking about internal costs, which the law could affect it from within. So these are things to consider when computing depreciation. When computing depreciation. So what are the methods which we say when we're considering that method to your consider to we will still have class for this. We need to do everything one on one all those methods. So method of depreciation, we have the straight line method. Straight line method means that every year it is so every year you are going to be removing this amount. You are going to be removing this amount. For example, if the car is 100 naira and you want to use it for 5 years, that means every year you'll be allocating 20 naira for this car, 20 naira. The first year, 20 naira, second year, 20 naira, fourth year, fifth year. Let's make it 100 naira. So that's a straight line method. And if the amount is fixed, is the amount you take from it every year. depends on what level. Also, reducing balancing or diminishing method. This is the percentage that have to be removed every year. Is the percentage. That this same 100 naira, then first year is going to be 20%. 20% of 100 naira. 20% of 100 naira is 20 naira. The first year, it will be 20 naira that you know. So that means the balance you have is 80 naira. So from that 80 naira, you take another 20%. 20% of 18, 20% of 18 naira is what? You're trying to look 20% of 18 naira is 16 naira. Then the second year, it is 16 naira. You know. So if you move from the balance before, balance before, which is 18 naira, you have 64 naira. The following year, another 20% of 64 naira. That's 12.8 naira. You move in the third year. And you move it again from the 64 naira balance you were having right from the beginning of that third year. So you'll be having, so some as you just do calculations, you continue to see that reducing the balance.
Excuse me, Mr. Samuel.
Yes.
Please, we can barely hear you. I don't know if the students can hear you loud and clear, but we can't hear you, sir.
Okay.
Increase the volume on your device.
Hello? Can you hear me?
Yes, it's clear now.
It's clear now.
Yes,
Okay.
please. You can go ahead.
Okay, we can't hear you. Precious. Okay. Let me move back a little bit. Okay.
Precious, please, can you hear him now?
Yes, you can. Okay, you can you hear me now, Precious?
Yes, it's clear now. It's better now. Thank you.
Okay, yes, better now. Okay. So let me start all over again for those who did not hear me. So let me start all over again. So depreciation, as I've said, I said it's the fall or decrease in economic value of an asset, economic value of an asset that you have. There's always when you buy something now, the moment you buy it, just know that the depreciation has started occurring on it. Because the amount you buy it, you will not be able to sell it at that same amount again. It will reduce. That's where you have the token balls, and when you have the brand new, you have the token balls, you have the legendary, because the depreciation has reduced it, so you cannot get the exact value again. I don't get the exact value again. Why it's produced wear and tear because you use it, the way you use it might be that it's a half of things or thereabouts, like making things to reduce its value. Reduce its value. That's what we call depreciation. When there is a reduction in the value of an asset, when there is a reduction in the value of an asset, so that is where you have depreciation. That's when you have depreciation, and those aspects we're talking about, these are plants and machinery, these are motor vehicles, these are furniture and buildings, and thereabouts, all those aspects that you get. And I said, the reason why land can be there, because land does not depreciate. Land does not depreciate. Land always appreciates. Those who bought land in the 70s or 80s, maybe this brow area at Thailand, they are one enjoying now. The plot of land then would be just around how much, let's say, the plot of land maybe in the 70s, 80s, maybe in the area. The highland over there could be less than maybe 5,000 or even less. But you want to sell down one plot of land today, you know how much you're talking about. You're talking about hundreds of millions. Hundreds of millions. That's what we're talking about. Hundreds of millions, because land appreciates. But all these items said here, they don't appreciate, because once you use it, it depreciates. It depreciates. That's why you have to know what you buy sometimes. And you see that more, as I said, you see that more on phones, especially when there are new technologies. When there are technology brings another one, before you make use of this one, it brought another innovation. And it makes the one you use to be obsolete. It makes you feel as if you're not part of them anymore that you're using those phones where you're now rocking your phone. That's not happening. It's just caused by just and everything. So the plant and machinery, the motor vehicle, furniture and fitting and building expenses, these are the aspects that are associated with depreciation. And as I said, causes of this depreciation, what are the costs of this depreciation? What will be the reason why this is occurring, that physical factor, as I said. Wherever you are, if you go ahead and go and buy Bugatti, you have a car Bugatti and you come to mainland, then you come to Congo and you want to prove yourself that I'm a big boy, I'm a big girl, you're driving a Lamborghini or Bugatti in that area. I'm sorry that your car is as good as gone. Because which road, you better put rims on it, start flying with that car. You know, flying that bad road. So physical factor affects it, wear and tear, the way you use it also affects it also. Passing of the time you use it also too. And it could be also this, as I said, technology could affect it, government policy could affect it. So these are the causes of depreciation. These are the causes of depreciation. Also, like the passage of time, so assets like patent rights, these are also assets too. Trademark, patent right, copyright, they are also assets. So which what you do is you amortize. When you get to that level, to talk about that amortize. So this word amortize for those intangible assets. Sometimes for those intangible assets. So then factors to consider when you want to do your depreciation. What are the factors you need to consider? When you want to sit down and calculate your depreciation, when you want to sit down to know what amount am I going to be marking for this aspect. So look at what method am I going to use. We have different methods in calculating the depreciation. So what method am I going to use? Then cost of that asset too. Consider the cost. What's the cost of that asset also? And also estimated useful life. For how long do you want to use it? Your phone, you want to use it for 15 or 20 years before you can use it and buy another one? Or you want to use it for just 3 years? It depends on how you want to use it. Useful life. I just want to use it for 3 months and get another phone. All depends on you. And the estimated scrap value is when you want to get another one. How much do you think I'm going to sell it? What's the scrap value for you? So that is what scrap value is. Then the internal and external causes of the depreciation, government policy, the technology, and everything, which are causes of such depreciation, which are also causes of such depreciation. To start getting your questions ready. So method of depreciation, we have the straight line method. Once again, straight line method, you have, let's look on an example. Your phone, okay, what you are really familiar. Your phone is you bought your phone naira, bought your phone 50 naira, and you want to use your phone for 2 years. You want to use it for 2 years. You want to use it for 2 years. So how do you now want to allocate some amount in a quick place for this institution? So if you want to begin yearly, it means that you have to be putting aside 25 naira. You have to be putting aside 25 naira for that 2 years to make 15 naira to make up the amount you bought the phone. So the other one, you know, just add little money to you to not get the new one. So the straight line method is that amount will be fixed. So if it is for 2 years, that's 25, first year 25,000 and 25 naira, the second year is 25 naira, so just 25 naira. If the 100 naira, if the asset is 100 naira, you want to use for 5 years, that means first year will be 20 naira, second year 20 naira, third year 20 naira, fourth year 20 naira, fifth year 20 naira, right? Very easy. It's very easy. Using balance method, that was quite different from straight line because this one, the percentage is fixed, but at the end when you do the percentage, you don't get the right amount. So if you are using project, if you are using the asset for 5 years and it's 100 naira. And you want to be charged 20% every year. Times 20% of 20% of 100 naira for the first year, 20 naira. So at the end of the year, the amount of the assets will have been 50 naira. The second year again, just remember that asset, which was 50 naira in the first year, has come to 50 naira in the second year. Another 20% on that 80 naira, which is 80 naira, 20% is 16 naira. So 16 naira for the second year. And when you deduct that 16 naira from the amount, you're having 74 naira, 64 naira. The third year, you take another 20% on the 64. So that's using balance of the relation method. The relation method, that's it, using balance of the relation method. Machine output. The valuation method. So this is at the end of the year, you value the asset again. Value the asset that at the end of this year, what will be the value of the asset? You look to match the value, okay, this is what it was, okay, what's going to work now, this is what it was now, and you put the amount there. That is what's worth now. So that's what you value. And you value it, that is what's worth this time around. So that is what the valuation method. The matching power rate method. So if we're talking about the plants, we use the batteries, so the machine they use. So they calculate the precision based on the hour the machine used, based on the hour worked on the machine. If the machine is running, if the machine runs from the factory where it is large production, and the machine, they look at the time it starts and the time it stops, maybe from 7 o'clock a.m. and the machine runs to 7 p.m. So they look at the hour. So from that hour, they need to calculate the depreciation of that asset also. And some of the years, and some years of the asset. So we see, we have examples of it that we do. Some years of that asset and we divide it. Be able to know the cost of the depreciation, or be able to know the cost of the depreciation. So these are methods, these depreciation, which we will at least need to end this year today by next Saturday, we shall continue from the position where we'll be going into the final account and everything. Is there any question? Is there anything? Is there any place you want me to, in the next 30 minutes I have? Is there any place you want me to brush on, or if you don't really understand? So in the meantime, when you're still thinking about that, I want to share this. I have the classwork. So I need those who are with their laptop and type into the chat room, or if not, you just get your pen, get your Bible, and get your paper, and let's do this together. Let's do this together. Hold on, trying to share with you. You cannot see it. You cannot see it. And if you see my screen, please indicate. My screen, please, can you indicate?
We can see your screen.
Good, good. So let's look at this. So based on the account to debit and account to credit, from A to H, let's look at the first one. Let's all look at it together. And type into the jar for the A, gross furniture by check. What will be, which account are you going to debit? Which account are you going to credit? Let's go in, let's type Which account do you think you need to? Because I said the principle of double entry. For every debit entry, there is always a corresponding credit entry. Two accounts will be affected. Two accounts will be affected. So, A, what pointer by check? Which account? Which account? What are the two accounts that will be affected? And which one will be debited? Which account will be debited and which account will be credited? Yes? Yes? Anyone? I'm waiting. We still have up to 8. Start doing that. Let's quickly do it. I have limited time. What's furniture by check? Which account? So just know that furniture and check are the two accounts that are affected. Furniture and check. Furniture and check, we're talking about bank. We're talking about bank. We're talking about bank. So we bought furniture. We bought furniture. So the account furniture is coming in. We get furniture and the credit bank. We debit furniture because furniture is increasing. And mind you, if you look at what I told you, the assets need to be debited. Assets need to be debited. So we bought furniture. So something is going out, something is coming in. So asset is coming in. While the money you have in your bank, the bank account, going out. So furniture and bank. This commission by check. I'm not saying no one is responding. No one is responding. I'm not seeing any response. Are you all with me or am I on my own? Am I on my own? Okay. Okay, so account to the furniture and check, yes. Good. Yes. Yes, good. Salmon. Thank you for that. Thanks, Salman. Thank you for that. The furniture will check, just say bank. So you're right to check for bank, not as bank, because the check you take to bank. So the bank accounts you have, not really check accounts. So the second one, also, you see commission by check. You see commission by check. So commission, more or less saying, the commission was paid to your bank. The commission was paid to your bank. Which account is receiving? Which account is giving? Which account is increasing in value? Is increasing value, and which account is giving out value? Yes. While my account, yes, your account, yes, you can call it commission account. Your account is also your bank. You can see. Okay, so bank, because money is coming into the bank, then commission which you see, commission. There. So, all right. So next one, paid wages by cash. Paid wages by cash. Yes. Fastest finger. Paid wages by cash. Paid wages by cash. Two accounts. What are the two accounts that affected this statement? So which one is giving out? Which account is taking it? Which account is taking out? Which account is taking it? Paid wages by cash. Money is going out from somewhere to another account. Money going out from one account. What is the account? And it's going out to another account. What is the account? Fastest finger. I'm waiting. I'm waiting. I'm waiting. I'm waiting. Fastest finger. Yes, 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 yes. Yes, that's the two accounts being affected. Honestly, you are right. So which one am I to debit and which one am I to credit? Which one am I to debit? Which one am I to credit? Debit bank. Paid wages by paid wages by money going out from your bank and coming to wages. So Michael, think about it. You cannot debit bank because if money is coming into the bank, then you debit it. But money is going out. Yes, wages is debited. Salmon, wages is debited because you are paying wages. So wages account is taking it. Then debit your sorry. Paid wages by cash, not even bank, rather. Paid wages by cash. So what we just is that you just debit, you just credit cash, not bank. Just credit cash because not bank, it's not by bank, but by cash, you have cash. So cash will be credited because it's going out, it's taking out. Cash is going out. So next one, cash sale. Cash sale. What are the two accounts that have been affected? What are the two accounts that have been affected? Cash sales that the made payment, but the payment was not on credit. It sold goods, which was not on credit. When they sold it, they received the cash. That's cash sale. When they sold it, they received the cash instantly. So what are the two accounts affected? So which account is given out? Which account is taking it? Cash sale. Cash sale. Yes. And those who cannot relate to type on platform, just get to people and start doing it also to know if you are correct, if you are right or wrong, so you can make corrections. Just get your pen and do it. So after doing it, you're able to know if you are right or wrong. Cash sale. You sold goods went out, and you have sold goods and you receive the money. The salmon, cash sales account, fantastic, fantastic, fantastic. Debit cash, fantastic, fantastic. Debit cash, and then those credit. So that sales account and cash account because it's sold. When it's sold, to something. Now purchases, cash purchase, cash purchase. How do we treat that here? How do we treat cash purchase? This let's all join, just type it. We are here to just learn. So even if you are wrong, we correct each other. From there we need to know. So let it just not be just one-sided, one person just type, let's know. If you're wrong, we let you know, you correct you, so you understand it better. Cash purchases. That means you purchase something. What are the two accounts that are affected? So which one is going out? Which one coming in? Which one, honestly? So, honestly, so you purchase the good, which one is going out and which one is coming in? Good. Salman, thank you. So you debit your purchase because purchase is coming in, the cash is going out. It's not in the account. And cash. So it's the opposite of sales purchase. Sales purchase and cash purchase, they are one and opposite, they are opposite each other. The cash is at the debit side for one. When it comes to other side, when it comes to the another account, they are at the credit side. So started business with money in the bank. Started business with money in the bank. How do you understand this? Listen, just take it breath and think it through. Just look at it. Some accounts that will be affected. We told you about this class of accounts, personal accounts and impersonal accounts. The accounts that we create. So which of the accounts being affected? Yes, Michael. Yes, credit business. Yes, credit business and debit bank because the business is putting the money into the bank. In as much you know that money is into the bank, that means number one, the debit bank. Yes, debit bank. And when you start business, that's capital. The capital. So you're right. You're right. Yeah, so good on credit to Mr. Tinubu. I didn't put president, so it's not one. I said President Tinubu is going new. No, I did not say that. Mr. Tinubu, I put there, not President Tinubu. That's two different people. So let's get this clear. So sold goods on credit. Now you sold goods. So goods on credit to Mr. Tinubu. What are the two accounts? I said, what are the two accounts that is affected? Waiting. Anyone? Anyone? So goods on credit. Tinubu. Sold, sales. That's an account that is been affected. On credit, it was cash. We just write cash, but there was no cash. That means there's somebody that's owing us the name. Okay, good. Michael said, Mr. Tinubu, the credit debt. No, 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 no. The sales we look at, the good ones like the sales account, not goods account, sales account, sales account. So the sales and Tinubu. So which one is taking and which one is sold goods Tinubu? Sold goods Tinubu. So which one? And I think the one that's receiving is deficit. And the one that is giving out is credit. The one that's giving out is credit. The only way you can use credit is if it is fixed asset. That one we put in there. Fixed asset, but it's not fixed asset. It's normal day-to-day run of the business. There are sales, there are purchase. So it cannot be Maggie accounts or this about it is what you are doing. So you go into the debited goods and the goods. This is sales. Sales because you sold it. Account, sales account. Sales account. So you need to know the classes of accounts, the personal and personal account. So that is what we have. So Tinubu needs to be debited. So the last thing. Fourth generator on credit from Mr. Downvote. Fourth generator on credit from Mr. Downvote. And I say, what's the name? What's the name on credit from Mr. Downvote? What are the two accounts that are being affected? Or no, or let me take it back to the generator because when I use cement, more or less you are saying this is generator, or generator is an asset. If I use cement, so we're talking about purchases. We're talking about purchases because it's more or less like I want to use for your day-to-day. But when you talk about generator, you know it's another principle of account, another class of account, assets, another class of assets. So what are the two accounts affected? Two accounts affected. I'm waiting, trying to look at the time so we can move forward to this. We have one more example. Looking at the balance. No one? No one? No one? Generator. You bought generator because it's an asset. Generator. Generator. Or if I put cement, it's just the word purchases. Because the purchases, if I put cement, it's just the purchases. It's just the purchases. So if I put cement, it will just be purchases. It will just be purchases. But I'm putting generator because it's fixed asset, it's the class of account. So it's generator taking and down go to the credit because down go to that with us. So down go to yes, Salma, that's why I said if I put cement because generator is an asset. It's a class of account on its own. It's a class of account on its own. But cement wouldn't be cement will be part of the day-to-day running of the business and expenses. But generator will not be an expense, an asset on its own. Whereby it will not be anyway, as time goes on, as we do final accounts, we know what item will be in final account and what item will be in balance sheet. So far, we know the principle of double entry for all these. Now, I know the principle of double entry for this. Now, this all down. So let's see this. Mr. Chiku has the following transaction for the month of January. As for the month of January, this is his transaction. This is the record keeping. He made cash purchases of 2,000, cash sales of 20,000, paid wages by cash 1,000, paid insurance by cash 1,000, settled Olu by cash 3,000. Now you are required to record the transaction, balance off, and prepare trial balance. So with these 1, 2, 3, 4, 5 transactions now. So prepare an account for it. Prepare it and please work it to the extent that you get trial balance. So let's look at the first one. So please follow cash purchases. Cash purchases. Look at the cash purchases we have under E. Under E, cash purchases. The account that will be affected will be purchase and cash. You can see purchase and cash. Cash purchases. One I highlighted. Purchase and cash. So we have to account purchase and cash. So we open an account. That's the ledger account. This is, you can see, this account you are seeing here is the cash and the second ledger, which is purchase. You open the ledger. And the first statement says cash purchases 8,000. So what do we say? The debits, look at it again, the E. The E. Debit purchase and credit cash. The debit purchase and credit cash. So cash, you credit cash. Under your cash account, is on the credit side. The purchase on the credit side. Under your cash, you credit cash. So everything under your cash, you always put the figure on the credit side. Everything under your cash account, you put it based on what we just seen. So everything under not so let me phrase it, not everything, but based on the transaction, cash purchases, the credit cash and the debit purchase. So that's why you can see purchase under the credit side of cash account, which is 6,000. And go back to your purchase account, you can see you now put on the debit side of the purchase account, all the name, all the other accounts holder, which is cash, 8,000. 8,000. You can see. The next item, cash, 20,000. Cash sales. The two accounts that be affected is cash and sales. That means the debit cash and the credit sales. The debit cash or cash sales. You sell, cash will increase. Cash will come in because you sell. Sell your goods, sell your products. Cash will come in. Cash will come in. So under this cash account, you can see 20,000. 20,000. Cash sales, 20,000 will be there. Then the corresponding entry, which another sales account will open. Sales account will open. It's just keep all this video I'm writing on. Don't look at this video. Just look at the name cash. So very soon we get to this video. So don't let this video confuse you. Just look at the cash that is written here. Because I've been paid, I'll not be paid, I'll just be doing it schematically, but because of time, if I start typing and everything, it takes time and it's going to run our time. So 20,000. Let's run faster. The next one says paid wages by cash. Again, mind you, we open our cash account already. This is our cash account. So every transaction that involves around cash, we just put it into another cash. You need to open another one again, another cash account, open another one and cash account. And we're synchronizing everything. That's synchronizing everything. So paid wages by cash, 1,000. So when you pay wages by cash, it means it credits your cash and debit your wages. Wages coming in. So wages is increasing. Wages is getting value. Why cash is reducing value? Because we pay is reducing value. So you come here, the wages 1,000. Then you create the ledger account for wages, because you not created that. As you can see on the debit side, because wages increase in value. Cash 1,000. I hope I'm clear. Paid insurance by cash. Also, paid insurance by cash. Paid insurance by cash. So insurance again, we put it because you are paying. Cash is reducing. You are paying. Cash is going out. So you can credit side. Insurance 2,000. And open the ledger account for insurance. Cash on the debit side. As we record it in the credit side of cash, the under insurance will be on the debit side. 2,000. You see here. You see here. And lastly, settle Olu by cash. That means we're owing Olu, we now have to settle him. We owe Olu, we now have to settle him. So settle Olu by cash. You can see 3,000. So cash is taken out again. So that's why you see Olu 3,000. Olu 3,000 and open Olu account. The cash that was taken 3,000. Any other transaction? No. So as we don't do like that, then we balance it up. At our debit side here, we have 20,000 based on the transaction. That's out of the 20,000 we have. Then from that 20,000, these are things we did. These are things we did, which is 8,000, 1,000, 2,000, and 6,000. 8 plus 1 has 9, 9 plus 2, 11, 11 plus 3, that's 14. 14. So out of the cash of 20,000 we have spent 14,000 naira. How much will you be left with? That's when you have your balance carried down. Balance carried down 6,000. This is the balance you have in your hand. This is the balance you have in your hand. It's no more 20,000 again. It is now 6,000 naira you have. So your balance as at the end of the month of January is 6,000 naira. So that's why you now bring the balance brought down 6,000 naira. So this is what is going to our balance. This is what is going to our balance. At the end of it all, you spend this, you spend this, you spend this. This is what is remaining 6,000 naira. This is what. So as you have it at the credit side, the balance will be, then bring it to the next month, which will be February. That's as at 1st of February or as at the end of 1st of January. This is the balance you have in cash, 6,000. Now we'll go straight to your balance, not 20,000, because this is the beginning and other transactions has occurred. You cannot be putting 20,000 there because other transactions synchronize everything. So, or it's that's for cash. So it goes in our balance for cash, which is 6,000. Then the purchases is the only one transaction we made in purchases. This. So, and at the end of the month, we only made the purchase of 8,000. That is why we have. When we're making other purchases, we just be seeing it next, just the next under cash, we just be seeing it there. But it was only just one transaction. So at the end of the month of January, it was only 8,000 naira purchase we made. So we bring it down. We bring it down. When you bring it down to be at the other side of the ledger, which is this 8,000 naira purchase. This is what going to into our balance. This highlighted here. Going to our balance. Sales. What sales we do? Only one sales we made, which is 20,000 naira. At the end of the month, we were only able to make 20,000 naira sales. So bring it down to the other side. Balance is 20, and this 20 is what we go to our balance. We go to our balance. Same thing wages too. Only made one transaction in cash, 1,000. And at the end of the month, it was only 1,000 remaining. You can see. Then bring it down to the other side, 1,000. So this is what go to our balance. Same thing to insurance. As you can see, only one transaction, you bring it down and what it goes. The Olu will settle also. So at the end, it was only Olu will settle in cash that we are holding that we settle. So when you settle, you need all these three and this three and this two and this two, just make sure balance. So that's what the balance there. You bring it down, which is 3,000. So when you're now making your trial balance, the balance we have under cash is for 6,000. The balance we have under cash is for 6,000. You can see the balance we have under cash is for 6,000. So the gross. Here. Side. It's in the ledger, this side. The purchases that we have 6,000 naira, which was also, you can see at the debit side, it brought to balance. The sales, which was at the credit side, you can see from here. At the end of it all, when we bring it down, it was on the credit side. So we bring it to the credit side of the balance. And also wages, which is also there. You can see. As you can see, wages at the side, 1,000. Same thing to insurance, 2,000. And the same thing Olu account, 3,000. 1,000, 2,000, 3,000. So if you do the commission of this, it's 20. If you do this only, if you don't see what our balance will look like it must be accurate. This achievement is accurate. If there is a discrepancy between the credit and the debit, it means there's something going wrong. It means there's something going wrong. So, right, so cutting. Any questions you can see the 1 hour, second half, or is that really enough for us? For our next session, we'll be doing more of this practical. We'll focus more on this practical for better understanding. For better understanding. Any questions or if the monitor can take over? I hope you all got something. I hope you got something, you've achieved something, but I will advise that you go home also, take time to look at it one more time, work on it over and over again, master it, the principles, the equations, and everything, and so you know you get it. So, thank you, thank you, thank you. Monitor. Monitor on the call. Hello, Madam Edith.
We can hear you, sir.
All right. So I don't know if anybody has any questions. Since I've seen that you're ready to, I don't know if there will be time that be given or I don't know.
Okay, so feel free to ask your question. It's question time, please. So feel free, wherever you are hooked up, feel free to ask your question for more clarity. Anyone? You can chat, you can write your question in the chat box. Is someone talking? Okay, Mr. Samuel, it seems, okay, there is a question for you, sir. Hello, Mr. Samuel. There's a question for you. Someone says, can we get assessment document for study?
Yes, I saw it. I didn't know I muted.
Okay. Please, sir, we can hear you.
I muted mine, so I was even responding to that question. So,
Okay.
that so you get it, you get the document. So I guess Madam needed to do so after this session and share it, and I think it will be forwarded to you. So he said, can you re-explain the trial balance? That's honesty. Can you explain the trial balance? Yeah, so as I said, are you talking about based on this example or trial balance as a whole, as what we talked about, or just the example, this calculation we did? So then, because of time, but as I've told you that after the ledger, the following means after the ledger, right from the source document, you post all those transactions to your journal. From the journal, it goes straight to your ledger whereby you open this class of account and everything. So from there, you now bring it to trial balance. And I told you trial balance, always check the arithmetic accuracy of the financial statement. Check the accuracy if you are right. If there's something wrong, all right, if you let you know, the trial balance will let you know because the debit side must be equal. The balance of the debit side must be equal to the credit side. The debit side must be equal to the credit side. If it's not equal, that means there's a transaction you are not doing. There's a transaction you omitted, or there's a transaction maybe you made a mistake on. So that's trial balance is there. So when you do the trial balance and you discover that yes, you get the right amount, at least it gives you an indication that yes, I'm on the right track, I'm getting it well. So that's what trial balance is really meant for. So after your ledger, that's why I brought out these 5 transactions that Mr. Chukwu did in the month of January. In the month of January, Mr. Chukwu did 5. Let's look at it like this. Let's look at it like this. Let's look at it like this. In a layman's way, let's look at it like this. You sold something. You sold something. Let's say you sold something. You made a sale of 20,000. After you made that sale, that 20,000 naira is with you. That 20,000 naira is with you. Or let me say it like this. Let me say it in this way so that you understand. Let me start from the purchases. At least before you can sell something, you must have that thing. You must have that goods with you. You have the goods with you before you can sell it. So you have the goods with you, which was 8,000 naira. Okay. You have the goods with you, which was 6,000 naira. And you know that if you sell that goods, you know that you sell it for 20,000. If you sell the goods, which is 8,000, you sold it for 20,000, what would be your profit? I want you to type it. So the goods was 8,000, and you now sell. So you now sell it for 20,000. What would be your profit? What will be your profit? The profit will be 12,000. The profit will be 12,000 when you sell it. So to you have that because you have to remove the cost of purchase of that good, 8,000 naira from that. So when you 20,000, you remove the cost of purchase from it. At least your amount I use to buy is to remove the 8,000, that's 12,000. From that 12,000, with you paid wages 1,000. You paid wages. Maybe you have an apprentice, you have a worker, you have a staff. Paying for that month for January 1,000. You mean 11,000 naira with you. And you're paying insurance too. You are paying insurance. Maybe you have insurance to pay. From the 11,000 with you pay another 2,000 naira insurance. So from the 11,000, you're having how much? 9,000. And you have to, you hold Olu, you settle him out of the 9,000. Settle Olu. You settle Olu, which is 3,000 out of the 9,000 you have. You are left with 6,000. That is the 6,000 you're having in the cashier. That is 6,000 you're having in the cashier. So the amount you have at the end of the month of January. I'm not looking at the beginning because you are preparing accounts at the end of January. So because you made all these transactions, the wages, insurance, and everything, it's 6,000 naira. So cash 6,000 naira, which is at the debit side here. Which is like the balancing figure of this is 6,000 naira. That is why it has to be placed at the side of the 6,000 naira. 6,000 naira. So that 6,000 naira, the purchase you did, which is 8,000 naira, has to be there. The 8,000 naira cash which you did has to be there. The wages you pay has to be there. The insurance you pay has to be there. The Olu you settle has to be there. And the whole money that came to you then was 6,000 naira has to be there. So it shows that the balance that this 20,000 naira that I have with you, this is how this 20,000 naira I'm having with you, this is how it was spent in the month of January. This is how it was spent in the month of January. This 20,000 naira, this was how it was spent in the month of January. So all these way we posted this, the Olo insurance account are just the principle of double entry which we talked about here. Are just the principles of double entry. Talked about which account you need to be credited and which account you need to be credited. So they are just talking about the principles of accounts which we are talking about. So try and understand that. So let me go back to where the slide came where we have have the trial balance. So you can look at it one more time. What trial balance? What we are saying about trial balance. So you're able to understand what we mean by that. That's it. That's trial balance. So trial balance, we are saying the statement that leads the balances, of all general ledgers, all those ledgers with their balances, the balances at a specific point in time to test the arithmetical accuracy of the account. So the balances. So it ensures that the total debit equals total credit. Total debit equals total credit. The total debit equals total debit, as you can see. So all items with debit balance, that's the one I showed you from that word, is what we did. All items with debit balance in the ledger will be debited. All those ledger, those items that the balance, you just put it down on the balance, on the debit side of the balance. And all items on the credit balance, that still was the credit balance. Was the credit balance is balance brought down. I'm bringing it down. Bring it down to balance to be at the credit side. So the total debits and credits must be equal to each other. And as you can see, when I use the specimen, assets has to be debited. Expenses, the wages, the insurance, they are expensive. That's why you can see the format here. So when it comes to debit balance of it, all time will always be at the debit side. This is the formula. See, the last one, sales slash income. Sales we made that 20,000 was at the credit side. So learn this format. Assets will always be at the debit side. Expenses will always be at the debit side. So that asset expenses, debit side. Asset expenses, And when we talk about assets, you know all assets are the land and building, the motor vehicle, the premises, cash and cash equivalents, your shares and everything, they are assets too. So we have long-term assets, we have short-term assets, we have intangible assets. So we get to know. So we also think at the debit side. Your liabilities are your loans, the loans you got on the people you are owing. Also, the people you are owing, the loan you got. So as the people you are owing, will be there too, who are owing. So will be there. That is a liability. In your capital, that's what I said. Capital, look at your capital. Every time you say this started business, 100,000, what do you always do? You credit capital. Almost like you credit capital. So capital is something as that is money, your own money you are bringing into the business. So the sales and slash income will be at the credit side. That's that for trial balance. Capital for trial balance. Just learn this to it will also guide you. So any other question? Let me know. Moderator.
All right, Mr. Samuel, thank you so much for today's class. I believe we all understand, and for honesty, I hope that suffices. Okay, okay. Mr. Samuel, she says thank you.
Thank you so much,
So
honestly. So by next, I want to be doing more practical, so we get to understand it better and better again.
okay. All right, thank you so much for that. So like he said, next week, Saturday, we will be handling Principles of Accounting 2. Today's own was Principles of Accounting 1. And I believe we've all learned a lot. Okay, so this is to the students. If you are yet to pay your acceptance fee, please kindly do so. All right, kindly do so. Encourage your loved ones to register. It's absolutely free. And you will be glad you did. All right. So along during the week, there will be a video recording of calculations that will be sent to you so that you could learn and prepare your questions for next week, Saturday. So do well to check on our groups. That is going to be done. I believe that's all for now. I believe you've taken the assessment as well. Thank you so much for joining today, and we will see you again next week, Saturday. Do have a beautiful weekend.